Greetings and welcome to another episode of the Deal Flow Show. I'm JP Maroney, your host, along with my co-host, Mr. Paul Nicolini, from here at our team at Harbor City Capital and the Deal Flow Show team. And we've got Bill Corbett from Innovative Payment Solutions with us. And there's some history here.
There is.
So this is going to be a fun interview. We're going to talk about what a scratch golfer you are.
Yeah, you are.
No, I'm like, me on a golf course is like the Halari bird. Have you heard about the Halari bird? You know what they are? The Halari bird is a 3-foot tall bird that walks around in 4-foot tall grass saying, "We're the Halari." That's what kind of golfer I am. So. But looking forward to this because I want to talk a little bit about your background and let's start there, how you got started in the capital markets. I know you had a career in investment banking. And then I want to talk about the project you're working on now, the company you're running, which sounds very exciting. We're looking forward to, both on the show and offline, learning a little bit more about that. So maybe if you could just back up a little bit, talk about where you got started and maybe some of the early deals that you cut your teeth on.
Yeah, I would love to. And first of all, thanks, JP. And Paul, it's so great to get reconnected with you. It's a pleasure to be here today.
Me too.
But, you know, if I could digress, I spent 32 years on Wall Street. I cut my teeth at Bear Stearns, spent about 10 years at Bear Stearns and Lehman Brothers. Learned the business from a legend named Ace Greenberg, who was at Bear Stearns for about 60 years. One of the great companies in the entire universe, Bear Stearns, before the collapse. But Ace was an amazing guy. He taught you to have the utmost of integrity. He had a mandate at the firm that you call people back in 24 hours, and if you didn't, you're fired. And so always in the back of my head, I have this complex where I have to, it's compulsive, I have to return phone calls. And it's amazing if you live by that motto that you pick up business. You never know what's going to happen when you are, standing up and returning calls. And so I learned the business at Bear, and Bear Stearns, partner of mine. We started a broker-dealer in San Francisco. I was the CEO for about 12 years, called the Shemano Group. And we were pioneers in the pipe space. I know it's hard to believe, but there was a time where there was no internet and emails to maybe some of your viewers and your network. But the reality is we had to network. We had to use D&B cards. We had to use institutional rosters, S&P. And we were kind of early, if you will, in the mid-90s to the pipe space. I saw the internet coming and told my partners that if we don't pivot to something that has larger fees, we're a dead man. And Schwab, San Francisco company, was growing enormously. And we just felt that we had to change. So I think it's important as a businessman to keep your mind open. And, I heard one the other day. It was, mind's like a parachute, unless it's open, it's trouble. So we basically pivoted to raising capital as investment bankers for larger public companies, large meaning sub 50 to sub $60 million market caps. Informix was trying to keep up with Oracle by cooking the books, unfortunately. And as they threw out management, the stock had dropped to about a $50 million market cap. We raised $50 million for them. It took about 10 days. And that kind of, gave us a launch into the pipe space, both on our ability to execute, the relationships that we garnered through that. We brought Credit Suisse in and Susquehanna and a couple other really interesting and smart institutions. And we saved the company. It ended up being sold for $1 billion 3 years later. We leveraged that to do other pipes. And we were, historically, I would say, in the top 2 to 3 or 4 firms for, in almost 5-6 years in the amount of deals that we did in the pipe space. So that was it was a great learning experience. We all had a lot of fun. We did a lot of good stuff for public companies, and we used that as a lever to do bigger and better business.
I have a couple of questions related to that, but I want to go back a little bit. You were talking about your early start at Bear and Ace, you said?
Ace Greenberg, yeah.
When you look at people like that you followed, what were the characteristics that you think made them a great deal maker, great in their space?
Well, he was very interesting because he had the highest integrity I've ever seen on Wall Street. His word was his bond. He was a magician and an expert bridge player. So he had a keen mind. He was one of those guys that, was not infatuated with Ivy Leaguers, because he was competing with Goldman Sachs for 60 years. Bear Stearns for 60 years, never lost money in 60 years, which is extraordinary if you go back to the Depression. So they were very interested in hiring, young, smart, aggressive guys that really weren't going to fall back on, some pedigree and worry about making the call. So smart guys, but the main ingredient, JP, was integrity. He just told the truth, and he was very simple in the way he approached everything. He had some great lines. For example, if you don't want to be misquoted, Bill, don't give interviews. And, he was just a straightforward Midwestern guy that ended up in New York City and spent about 75 years there. And he was amazing, too, in the sense that when he was young, at 27, he had leukemia, and he beat it. And so he was very solid as far as a positive outlook on life, very grateful, had a lot of humility for being as successful as he was. And he was kind of the broker to the stars, the big players, the Larry Tisches. Some guy named Trump used to do a lot of business. You could hear the blocks going by, 500,000 shares of Hilton, in the 80s. That was a big deal. But he was a man of great integrity. And I think that's the key to that business for him.
That's interesting. What a testament. For those in our audience, and I know it's going to be some percentage that don't know what the pipe space is, as you say it. Let's define that for them, because it's funny, because we just got through having a conversation about this on Monday related to another potential public offering. But walk us through a pipe deal.
It's certainly not in the plumbing industry, but a pipe would be a private investment in a public equity. And what that means is you're basically marrying up, as an investment banker, a transaction where you're introducing a institution or a group of individuals to make an investment in a public company. And there's generally, in the days that we were doing it, there would be some restrictions as far as the Reg D and having to register those shares. I know consequently we've seen 144 shrink to 6 months, but back in those days we would put together a private placement. We would charge somewhere in the neighborhood of 8 to 10% plus warrants. The investor, you ask yourself, why would an investor do that? The investor is usually getting a discount to the current stock price. He's getting warrants. Sometimes he's getting a convertible debenture, so he'll get a coupon, maybe an original issue discount attached to that. So the reason one would do that would really be to get the warrants. Or maybe, the stock's not quite liquid enough to buy $1 million or $2 million worth of the stock. So the pipe allows him or her to participate in a private placement. And the pipe space was pretty early in the mid 90s. It's become commonplace. And ironically, during the debacle we saw in what was it? I guess it would have been 01, 02 when, it was 2008 when GE and Buffett made those $5 billion investments. Those were actually done as pipes. So it's a great way for, if you believe in a company, to own a large amount of the stock. Usually you can get warrants with these transactions, which it's like buying 2 shares for the price of 1. It gives you, some steroids, if you will, on the investment, if it works.
And that money, money's getting injected into the operating company as opposed to placed in the public markets with a traditional purchase, right?
Absolutely. And, the main thing from my perspective was being able to quantify the dilution, JP, so that, you could approach the board. Because, if you think about it, who's your real customer? And I've always asked that. Is it the individuals or the institutions investing in the enterprise, or is it the enterprise and the company itself? And I always felt that you're going to do right by the company, but you really are fighting for the investors, because that's the people that you're going to represent time and time again, hopefully with other transactions. But yeah, the money gets, basically injected into the business, hopefully for a good purpose and growth. And it is basically the hope would be that the company, and due to contractual obligations, would file a registration or an S1 for those shares as well as the warrants, so that if you're lucky enough that the stock moves off the discount that you bought it from, over the next, pick a number, 30 to 90 days, maybe a year, you generally can make a lot of money if you're right.
Nice.
I was going to ask, though, just from curiosity and maybe another perspective, what was the holding period on those restricted shares again back then?
Well, back then, Paul, it was 12 months.
I thought it was right. Okay.
But you could circumvent that legally with the SEC by filing an S1.
S1, right.
So, assuming you don't get a full review, which, the SEC could want to take it out a little bit further to get, more information from the company. Generally, the holding period would be sometime between 30 to 60 days for one to get through the S1 and get it what's called effective.
Does a Reg A that you see some public companies doing now, since they made it available to public enterprises, does that technically qualify as a PIPE?
I guess you could say that, JP. I mean, I really like what they've done with the Jobs Act. I think that it's opened up companies. It's been very difficult, as you guys know, for the sub $60 million market caps to raise capital. I think that general solicitation, which would have thrown us in jail in the 90s and the early 2000s, if the ability for the smaller companies to use Reg A, I think is excellent. I think the new legislation that they're passing through for Reg D to go from maybe $1 million to raise as much as $5 million is really good news. It seems to me, and I can't speak for the SEC, but it seems like they've turned the corner and decided to allow smaller companies more access to capital, including, changing some of the rules that are in place now. They're trying to change finders being able to raise capital for small companies, without being actually registered with FINRA or having a Series 7 or whatnot. So I think that's really compelling. To me, it's an about face, and they're starting to look at this environment, which has been brutal, as we all know, other ways and backing off from the restrictions of small companies and providing them access to capital that we haven't seen before. And I think Reg A, is a good deal. I think crowdfunding, any of these things, I think that enable companies to grab large amounts of capital to grow their business is a good thing.
You mentioned how y'all were going, you said institutional list, and I assume you mean basically in those days you were banging out the phones, right?
All the business was done on the phone, JP, absolutely.
So have you, and I know which we're going to talk about, you're running a public company now, but have you personally or with your colleagues seen this shift that we're hearing and seeing, where road shows, for example, are, Zoom shows now? I mean, and people being able to create almost an accelerated roadshow path and raise as much or more money through that. Are you seeing the same thing, people's willingness to shift and do business in a different way?
I am. I mean, look, we all know that meeting people in person, especially if, you're somewhat professional, is better than not, at least in my opinion. However, being in, San Franciscan my whole life, I think you're seeing a sea change out here, which I think will be replicated if it isn't already. Big companies. My daughter works for Facebook. My son's at a company called Indeed, and these companies are basically saying you don't have to come back. Maybe not ever. Now, and sure, engineers are probably going to have to show up, but the whole dynamic is changing out here. I don't know about New York, but for example, LinkedIn in San Francisco is saying there's no reason to have an office anymore, which is pretty extraordinary, and I think what you're seeing is that people are able, to work on their own, to motivate themselves, to do business. They're seeing that in the last couple of quarters, despite the COVID. And I think that they're more productive. Ironically, you're not sitting in a car, and the Bay Area traffic's gotten to be ruthless. So if you're in a car for 3 hours, you've got another 3 hours in the day to be more productive for your company. So I think you're seeing a sea change. I wouldn't want to be long a lot of commercial real estate in some of these places, but I think you're seeing a lot of dynamics that have shifted, to your point, that it's okay, you know, to be on a Zoom call. And I think that things are getting done, which is great. And I think that maybe, you know, a year from now, after this thing passes and hopefully, God willing, the vaccine starts working, we get back to going to conferences and meeting people. But right now, I mean, I don't see why one would want to get on an airplane and go sit with a couple hundred people in a room to go to a conference.
Yeah, that is true. You know, we've talked to a couple CEOs on the show, and they found it to be very effective doing the virtual roadshows. And and I think people are getting into that mindset that even when it starts to come back, it's like, where are their social skills again, right? About the handshaking and about the being at the bar and having the deal done at the bar, and you know, all that stuff may be just history.
I want to talk a little bit about the challenges with, as you said, sub 50 million market value raising capital in the markets today, if I understood what you said, in just a moment. But before we do, if you're watching or listening to this episode of the Deal Flow Show, you can get access to our previous archives, our previous episodes, as well as subscribe, follow us, get access to us by going to thedealflowshow.com, thedealflowshow.com. And by the way, we're also now, thanks to our team, on nearly every audio and video platform in existence. So big kudos to the Deal Flow Show team and everybody that's been working behind the scenes on this. But so Bill, explain what you mean by that. And is this something, maybe we could pivot towards what you're doing now, is this something you've experienced personally as a CEO now of a public company, or is this just an observation in terms of the challenges of raising capital in the markets if you're under that tier?
Look, I think relationships are key. And when you've been around as long as I have, you know, you have some pretty good relationships through the years where, look, I keep going back to integrity. I think my grandfather, who was a wonderful guy, told me, you know, when you lie, you have to remember. So at a very early age, I decided that I wasn't smart enough to remember anything. So I'm just going to tell the truth all the time. And I'm not the smartest guy, but when I'm dealing with people, there's an integrity factor and a transparency that I'm not trying to pull the wool over your eyes. I'm trying to give you as much information as I can about a particular company so that you can make, you know, an intelligent observation and decision to whether or not you want to invest in it. And that way, as long as you're working on the lines of integrity and transparency, you're building enough trust that through the years, you can continue to go back to that institution or individual that you have this long history with. So, you know, I've been fortunate enough to raise over $1 million in the last several months with some great institutions that I've known for some time. I take a mindset that, you know, as a CEO, it's a war on capital, and it's a fine line that, you know, you have to balance the aspect of dilution with being a steward for the shareholders. Because let's face it, I work for the shareholders, and I'm trying to increase shareholder value. And at what point do you take in some money, and how do you deploy it? What's the best use of that money? And how do you raise money at higher levels? Because ultimately, my responsibility, as I see it, is to raise money at higher levels as we build a growth company. And so I think in this environment, you know, you have to consider all options for raising capital. And I have found that, you know, we've been fortunate with some pretty good institutions that want to help us, you know, with the company and let it grow and invest in it. But that being said, you know, I think that you have to have good auditors. You have to have good lawyers. I filed an S-1 recently, and we got it through in about 9 or 10 days. I think that's representative of the fact that, you know, we have good auditors and we have really good lawyers that really know what they're doing. And I think that helps as a reflection of the company. And so I think in this environment, you just have to continue to network. You have to continue to work on existing and new relationships. And I think it's a knife fight in an elevator. You just can't stop. You just have to keep, almost evangelically talking about your mission, what you're doing. And I really don't judge, JP, Paul. I try to tell the story the best way I can, and see if there's an interest on the other side to help us, grow the business. So I think this environment is a tricky one, but I think it's getting better, actually. I know that sounds strange, but I think the environment is getting better. Low interest rates, public companies, offer as an alternative investment a little bit of a turbocharge to your portfolio, especially in the form of private placements.
You've raised a lot of money, Bill, in your career, and you've answered really a lot of this next question that I'm going to ask you. But what else can you tell our audience about the do's and don'ts in capital raising?
I know it's not an exact science, and it's hard to make generalizations. But I think there are certain things that you can do. I mean, if for example, I've probably raised over $1 billion in 30 years, and I never was one to charge upfront fees. I just always wanted to base, everything on my performance.
Success fees.
Yeah. I was always a sports guy, and everything to me is a microcosm of sports, and it's about performance, and you're only as good as, the last game you pitched. And I just felt coming into a new relationship, it would be unfair for me when you don't know my firm or me to say, give me $50,000 and I'll go do the best I can for you. And then, 30 to 60 days later, for whatever reason, you failed. And the guy says, what did you do for the 50 grand? And so I felt that would be very hard to justify. So when it comes to raising capital, I felt that, you really want to be performance-based, and in running a broker-dealer or having the distribution of a BD, your reputation is really, you don't think about that at 25, but, luckily if you did, when you're 35 or 45, your reputation is key. Your word gets around, the way you treat people is prevalent in a lot of different ways. So I think it's important to treat people fairly and honestly, and it gets back to, of course, to that thesis of integrity. But I just think that you got to know your customer too, guys. I think what we did really well, Paul, when we worked with you and running the BD as a CEO, I knew what my customers wanted, and really as a salesman, kind of as an investment banker, why sell your customer something that they don't generally do? It's like swimming upstream. Right. So if I know my customer likes liquidity, then I'm going to find companies that are liquid. And these aren't real estate plays. So if I can bring them opportunities that are liquid, that gives them an opportunity at some point down the road when they want to get out of the position that they can get out. And I think knowing your customer is really important. And I think that the ability as a banker to be able to quantify dilution is key, because there are a lot of characters out there. And if you can't quantify dilution to the board, I think it's something you might want to pass on, because I think it's important that you have fixed price conversions, fixed prices with board's ability to say, should we do this transaction or not? Because I think that the contingent liability going forward is, sure, if the stock goes up, it's great. But if the stock goes down, it becomes, not so pretty when someone's converting stock at, tens of millions of shares into your company, because you really should be able to quantify dilution. I think that's important.
I like your mindset of performance-based. Years ago, one of my mentors said to me, JP, sales is the only profession where you get paid exactly what you're worth. And I think anytime you can connect what you do to performance, it puts you in the yoke with whoever it is that you're working with. You're both pulling for the same success. And I know at one of the statements we make to people here at Harbor City when we're looking to partner up with a company is we say, we bring together and give people access to resources, capital, as well as new customers, which are the things that companies need to grow. It's what they feed on. But we also say we don't need our lunch money. We know where our lunch money's coming from. We want to win when you win. We want to win when you succeed. We all succeed in a big way.
Yep.
And I like that. But that also puts the pressure on you to evaluate and choose deals appropriately. So we only have so much bandwidth. So how do you evaluate? And I'm going back again to your previous work, but how did you evaluate deals? What is your process for defining, is this deal right for us? Is it the right time? Is it the right market? I get are these good people? And I get the whole bet the jockey thing. But how do you evaluate the deal to make sure it's worth you putting your energy into?
That's a great point, right? And as a greed animal, because most of us on Wall Street are, where's the path of least resistance to get paid? And selfishly for me, because I started at zero every year, like a lot of us did, where can I get paid? Where can my customers actually be put in a position where, one, I can get paid? It might not be the priority, maybe second. Two, where can they make the most money possible? And Jax would always say, I'm a visionary, and I'm looking for the big move up on growth or whatnot. Jax would always look for fixed assets on a balance sheet, and well, what the heck do I need you for that? And anybody would lend money against a good, solid fixed asset. Let's go find the hard deals, and when they work, they're extraordinary. They're 20, 30x in 12 months with warrants, and I was fortunate enough to be in several of those, and it's a great feeling, JP, when you make people money, when they make that kind of money. And as a banker, there's a lot of goodwill in that. When you make somebody 10, 20 times on their money in 12 months, 6 months, they tend to want to do your next deal, and so it makes your job a little easier when you got a little wind at your back and you've had you had a winning streak.
Fair enough. So how did you evaluate the deals? That was my question.
First and foremost, I would look at management, and we would do due diligence on management, to make sure there's no skeletons. We would look at the dynamics of the stock, go through the filing, see who the large shareholders are, see when the last time they had filed a reg statement. So we would do an extensive amount of due diligence, and I would look at it from the eyes of the investor. Is there a significant upside? Is there some inflection point coming, in which case, maybe there's an FDA approval coming and the stock might rocket. And so when you start looking at those things and you put them all together, then it gets down to, should I put my time and energy into this company? Because you're right, JP. Time is money. Your most valuable commodity is your time. And what's the opportunity cost in going down that path with someone that doesn't work out and you missed, the next 10x? And so that's always in your mind. I think the priority would be the individuals. I really think that the people that have had a track record of executing are the guys that you want to bank, and I've heard this before, and, I'd rather have, a quasi questionable, opportunity or technology with a world-class operator than phenomenal technology with an average operator. I think you can set yourself apart by piggybacking on guys that have had a track record. And, look at anything from Steve Jobs. Apple was almost bankrupt. He comes back. I don't think it's an accident, that it does so well. I think that if you look at Elon Musk, not that I got the opportunity to invest in anything he had, because they're all billion-dollar companies, but if I was at Goldman Sachs, I'd be riding Elon Musk, coattail the whole way. The guy just doesn't seem to make mistakes. He's almost like Marvin Davis, in the new century.
You talk about your sports analogy before too. You can say it, right? How does a coach go from one team to another, and all of a sudden that team is at the NBA Finals, in the World Series, and so forth? You're right. Yeah,
it's very true. I mean,
Yep.
I know talent has something to do with the team, but there's a reason why they're always in the playoffs. There's no question about it.
I normally don't like asking questions I don't know the answer to, but there's a book I read. I actually went back and reread this book several times over the years. It was a book called On a Roll by Howard Jonas. He was the guy that started the callback industry many, many years ago. He owned, I think it was Prodigy for some period of time, but way, way back. But he had a chapter in the book called Gold in the Gutter. And I've always been fascinated by this, and we've had personal experience with this, but he said some of the best people he ever added to his team were people who were exceptional performers, were great operators, or whatever their core skill set was within an organization, but for some reason they'd gotten kicked to the curb. It could have been an 08, 09 financial crisis. It could have been getting in bed with the wrong people, whatever it might have been. But they'd gotten kicked to the curb, and that he had found some of his best talent in the gutter, basically, that gold in the gutter. How have you been able to, over the years, assemble the teams for the particular projects? What do you watch for? And not just the leader or the operator, but the kind of people that you bring together for deals. How have you built the network? I mean, can you give us some sense of how you've put together that roster?
Yeah, I think that you're certainly looking for, hungry guys or gals. I think that you want people that have, had some success somewhere along the way. They work together. They share a common theme, which is they're street smart and book smart, humble, and they generally tell the truth. I think it's really important to be surrounded by people that are constantly trying to do the right thing. Wall Street's a tough place. You've got regulatory constantly with FINRA and the SEC, and you want to always be compliant. I was very fortunate. I was never sued and didn't have any customer complaints. And not that I was better at making people money, because I certainly wasn't, but you just try to always surround yourself with, a team of guys that are smart and that know what they're doing and bring value add. And I think people's skill sets vary from person to person. And so if you can find talent that fits into a group of people that share a common goal, which is to increase market cap, then everyone wins. And it truly is rewarding. It's a great feeling when you fund a company, the investors work, maybe they have a product that, helps leukemia patients, or, they have a product that helps the consumer in some way. So, I always felt that, when early in my life, I wasn't sure if I was going to get into Wall Street or if I was going to go sell insurance. And I just felt like, the opportunity on Wall Street was amazing to me because, I started gambling as a golfer when I was young. And to me, Wall Street was a little bit like that, but each day was different. And you'd meet companies and CEOs that love what they're doing. They're passionate about it. They give their life to it and they're committed. And I like people like that, and so I would constantly look for people that are like that. And then I would continue to make sure I was available to them. I would continue to perform any way I could for them with my brokerage firm, like you guys, having all kinds of ancillary relationships and that can augment and help build the business. And they get all of that under one umbrella, if you think about it. So in theory, you're setting yourself apart from a lot of your competitors because of the way you handle yourself and because of the things you bring to the table to that particular company. And I would try to do the same so that we would have multiple bites at the apple to help them fund round 2, 3, 4. Sometimes we'd have 4 or 5. We'd take them public. We'd do reverse mergers back then, and we'd take them public, and then we would have multiple transactions. And if they executed, they made you look smart. And now all of a sudden you're doing trades that, that were 2 or 3 or 4 or 5 million. You're doing 10 and 20 million transactions at multiples of where you did the first one years ago. And you're basically doing that not only because it's, it's self-serving. However, you don't want to lose that customer to a Goldman Sachs or a DLJ or, Morgan Stanley that are starting to come down to where you live, which is the microcap world. And when they are not doing so well, the last thing you want to do is see, your competition with in a bulge bracket that might have more resources than you. So I think that you're protected through the relationships that you establish.
Very interesting. I want to get into innovative payment solutions before we run out of time. Before we get into that, once again, if you're watching or listening to this episode of the Deal Flow Show, you can get access to our archives, our previous episodes, as well as subscribe and follow us and get access to our future episodes by going to thedealflowshow.com. That's thedealflowshow.com. And okay, so Bill Corbett, Innovative Payment Solutions. Let's talk about today. What is the business that you're running? And it's in my opinion, a disruptive technology and serves a great place in the market. I want to talk a little bit about that and maybe where you're taking the business.
Sure, appreciate it. Thank you very much. So when I was an investment banker, I took a company public called Quipagos, which was deploying, let's call it kiosks in Mexico. And we spent about 5 years. I helped the company, brought them public, raised capital for them, brought in some advisors, and tried to help any way I could, and built a business that was using about 2 million Mexicans in the network to send digital payments in Mexico, and was very, very compelling in Mexico because there's long lines to make utility payments or to make microloan payments. And this kiosk, which was a very sophisticated machine, had the ability to do that. We sold the business last year, did about 11 million. We saw an opportunity to grow a fintech out of Southern California that would focus really, JP and Paul, on the what we call the underbanked and the unbanked. And what we mean by that is these kiosks are extremely sophisticated. So one could pay a utility bill while they're standing in Los Angeles for their dad's utility bill in Mexico City, top off a cell phone. So we're in the early stages of building a fintech. We find it very exciting because these kiosks can operate as a bank, if you will, for the unbanked or the underbanked. There's more than 12 million in Southern California, all the way up to where I live. I live in Pebble Beach and run the business out of Southern California. But if you think of the breadbasket of Salinas, all the way down the San Joaquin Valley, 80% of the fruit and vegetables are grown in this state. And with that, there's $40 billion a year being wired to Mexico, $40 billion. And of which a large part of that comes from California. So our objective really is to deploy kiosks in the next several months that operate as what we would call a digital wallet. It has the machine will have the ability, the kiosk, to wire money to Mexico. We want to create our own stable coin. It's a dollar-backed stable coin that we can send money to Mexico with, that we feel would use blockchain in a closed loop. We think that's very exciting. And, when you look at the macro side, guys, this is a population, the underbanked and unbanked, that hasn't been treated too fairly by the oligopoly of the big conglomerates that have charged a lot of money to send money to Mexico and around the world for 20, 30 years. So we see this as convenient, having a kiosk where they can do these things, price competitive, where we think it could be cheaper than anything in the market. And we think that it'll settle quickly. And with an e-wallet, we have the ability for them to put money in the machine. We have these aggregators in Mexico that we have this long legacy with for 5 years. But with an e-wallet and they download an app, they'll be able to send money while they're sitting on the couch and not have to run out to the money transmitting businesses. And we think that's a really good point. So we're building a fintech. We think as a pubco, guys, we have many opportunities to add ancillary businesses and roll up some businesses into it. My goal, which is what my dream would be, to build a $200 to $300 million company in the next couple of years, and be successful at helping a group of people that could use a break and get a piece of this $40 billion a year that's going to Mexico.
Do you see this only U.S. down, or do you see this spreading out in other markets? We've had some recent conversations with our banking contacts, and the whole buzz in Honduras and Guatemala and everywhere is contactless banking, contactless subsidies, contactless bill pay. Everybody, because of COVID, it's obviously driving this. Do you see y'all expanding? Where do you see it headed to get to that 200 to 300 million?
I see, the world is wide open. I think you could send money to Mexico. You could send money to India, like you're saying, Guatemala. I think there's many different avenues for us to explore. I think there's plenty of business here to build a remarkable business just in Southern Cal up to the Central Valley and Salinas. However, if you look at the macro side, you could become really a distribution hub. So one comes up to the kiosk and they want to buy a lotto ticket in Mexico. They want to pay their dad's cell phone bill in Mexico, and they hit a button. Maybe they want a microloan, which I know is kind of a dirty word, but the reality is if you do it right, you're providing a good service. So let's say you want to get into betting on NFL games in one day. So if you have 1,000 kiosks throughout California, you wake up one day and you say, hey, I think the shareholders would benefit from having this in the kiosk. And so the kiosk really is in the path of their lifestyle, wherever that is, in a grocery store or a liquor store. And so I think if you get in with the right influencers, guys, you can spread like wildfire. If you're competitive and it settles quickly, I think there's all kinds of different businesses we could grow out of this. But it starts, I think, with developing a brand, getting them comfortable with sending the money to Mexico, and on the other end, maybe it's cheaper when on the receiver receiving it, and it's easier for them with the way they conduct their business.
Do you currently have the kiosks, or where are you in the process?
We have 60 kiosks in our warehouse in Southern California. With COVID, it kind of slowed us down a little bit. However, when I look at what's going on, remarkably, the wire remittance business to Mexico has gone up about 9 or 10% year over year, despite the virus and the COVID. So I think what we're seeing, guys, is people that do essential jobs, that pick our lettuce and that do jobs that are essential on the front lines, and they have money and they're making money and they're really committed to sending that money back to Mexico for their families. And so if we can help them with that and make it more convenient and cheaper, we think we could grab market share, and ultimately we think we can build a really compelling business around it.
When do you see yourself deploying these kiosks?
I would say to you that in the next 60 days, the next 35 to 60 days, we'll be deploying. We've got some great advisors that are helping us. We've got a great law firm that's into blockchain technology, advising us on what we should be doing, because it's imperative that you're compliant. Obviously, in everything that one does, you should be compliant. I think life is a lot easier that way. Right. So we're making sure we have good counsel on making sure that, we're doing everything the right way. Because if we build it properly the right way, we think we'll thrive. And there's no reason to do it anyway but the right way. So it's taking a little longer because of COVID, but sure. People are very receptive to wanting to put the kiosks in their businesses, Paul.
What are you considered? You're not a bank. What technically, how are you classified as a business?
Well, I think we're really fitting into the mold of the fintech, JP. When I look at some of these companies, It's a hot space. Square in San Francisco, I've watched grow from an early day. PayPal's killing it, and I'm not in any shape comparing us to PayPal, but they've gotten into the money remittance business. They've really hurt MoneyGram and Western Union. They're very good at it, and I would say we're a startup that's a fintech that is into digital payments and finding the quickest, cheapest way to make payments abroad.
Well, the reason I asked the question, and I don't know how deep you want to get into this or open this can of worms on the air, but the cannabis industry is historically one of those unbanked or underbanked industries because of the federal guideline or the I guess conflict between state and federal laws, right?
Right.
But in a reality, you're sort of an on-ramp to digitize cash.
True.
Right?
True.
And if you are an on-ramp to digitize cash, do you see a future for y'all in that cannabis industry? Is it sort of like you're okay if it happens, you just don't want to know about it? Or is that a serviceable, because, obviously with Patriot Act and all, those are the things you're dealing with certain limitations and caps and all of that. But I know these guys, some of these guys, they got, pallets of cash. They're paying their taxes in cash. They're paying their employees in cash because they're unbanked.
Yep. It's a good point. Being in California, I would welcome it. I've had discussions with banks. I think ultimately, if we could find a partner in a bank that was wide open, I know that's a slippery slope with the way the feds look at it, but if we could find a bank, we could really help the cannabis industry. I want to focus on proving the platform in the short term with money remittance and payments and a distribution system. But I would think as an adjunct, that's a phenomenal business. Absolutely.
Yeah, and you're speaking my language when you talk about having a platform and then looking at that platform from a perspective of monetizing with multiple opportunities and offers. So many businesses, they get the blinders on and they see their particular product, that they're selling that product and they're going to go look for more people, as opposed to saying, here are the people I'm solving problems for. What are the other problems that I could solve for them, for those same people with a singular acquisition cost? And kudos to you and Innovative Payment Solutions for what you're doing.
I wanted to ask though, Bill, are you guys in the middle of any kind of funding round right now? Are you looking for capital right now, or?
Not right now, but Paul, as we talked about today, I think one has to keep an open mind into raising capital. I think, in 30 years, I can't remember seeing a CEO looking at me saying, Bill, I don't really need any money today.
Okay.
So, I'm just amazed at all these different businesses that I've funded or I've gotten to know. They all need money all the time. So I would say to you that I'm always looking for partners to help us grow. I'm trying to expand eyeballs. To me, I think liquidity is key. I think it's the lifeblood of pubcos, and I think that one has to keep an eye on making sure their stock has got eyeballs on it, and you're relevant, and you're putting out press releases that are completely compliant, but that are in an orderly way, informing the shareholders or people watching you. So I would say to you, I'm always open to looking at ideas, especially if we can execute, then we get the stock higher through that execution. We're raising money at less dilutive values, because down here we're a small company, but I'm a little selective on opening the floodgates down here. But that being said, I'm always open to discussions about capital.
The Deal Flow Show team sits at the center of Deal Flow. And like I said, we have resources, capital sources, people with opportunities. What kind of people would you like to hear from our audience or be introduced to by Daniel Pinaranda, our producer, Paulie, and myself? And then what's the best way to reach out to you?
I would say my website would probably be the best way to reach out. I'm very interested in expanding, my network. This is the first time I've been a CEO after, 30 years on Wall Street. So, I'm open to people that you think they can create value for my shareholders. I've got an advisory team that I'm putting together that it's exceptional. They're wonderful guys. They have a great track record. Anything that I can do to raise awareness to the company would be good for my shareholders. So I haven't really done much at all on IR/PR. I'm going to start to look to kind of do some of that stuff as we get ramping here. But I would say to you guys that anyone that has a track record and it looks like value add, I'm always looking to try and increase shareholder value. And I feel like a coach in a way where I'm gathering advisors and people to the team that I think make us a great ball club, and hopefully with aspirations to play in the playoffs and eventually win a championship. My goal is to make the shareholders a bunch of money and see evaluations that make us proud over the next several years. That's kind of what I'm doing. It's my full-time position that I live and breathe, and hopefully we bring the right players to help us do that.
Very good to make your acquaintance. Looking forward to our offline conversations as well and seeing what value we can add to Innovative. If you're watching or listening to this episode of the Deal Flow Show and you're thinking, maybe I'd make a good guest for this show, or maybe I know somebody who'd be a great guest for the show, be sure to reach out to us at thedealflowshow.com. Of course, when you get there, you can also subscribe, follow us. You can get access to all of our previous episodes as well. On behalf of our team here at the Harbor City Capital and the Deal Flow Show team, Mr. Paul Nicolini, I'm JP Maroney. Bill Corbett, Innovative Payment Solutions. So good to have you on. We'll see you, everyone, in the next episode.
Thanks,
Take care.
Billy.
For more episodes, visit thedealflowshow.com and subscribe.